this recording. And see, this is what is the plan. So what we will be doing is we will be revising on a daily basis each chapter in FR. We go, so this month I'll start with FR and DB. Okay. So every day I will upload one video for FR and one video for DB. So let's start with FR, and this would be the plan. Let's discuss the plan also first. Okay. And the target is November 2026 year final exams is what I have a target. And a new chat. Okay. So see, majorly four difficult standards we have. All others are simple, simple, small, small, right? So one is leases, which is quite big. And the next one is 115, obviously, revenue from contracts with customers and financial instruments, and this consolidation. And if we add as a fifth, like business combinations, we have this five difficult chapters. So that we will do at the last stage. Okay. So how I will be proceeding with is like I will take you through all the provisions of this chapter, and then the question and answers also will be dealt with. And at the last, okay, all the question and answers we will discuss in the last, and then it will mark as a complete. Then only we will be marking the chapter as complete. So let's start with first chapter, which is Introduction to Indian Accounting Standards. Yeah, so it's the base thing. Okay. So previously, why IndAS, right? So whenever, see, everything gets outdated at a certain point of time, due to new things coming up, new complexities coming up in the market and everything else, right? So similarly, in the accounting or finance industry, a lot of new options came up, new instruments came up, which were not previously covered in AS that we were dealing with. So, it necessitated the need for the IFRS, which we have converged it into IndAS, and we are following it in India. So that's the basic thing. And so this summarizes, the need why we had implemented IndAS. And one more thing is like if all the other countries are implementing IndAS or IFRS, and if we are not implementing IFRS, we will be, behind the race, right? And it won't be comparable also. If you take any financials, how we will do the consolidation for foreign subsidiaries or foreign parent companies, and how they will work. So there was a need for a common platform or for a common standard, you know, which we also had to adapt. So that is nothing but the IndAS, which is nothing but a convergence of IFRS in India. So we will go step by step, right? So all this will be there. This all are theory. Okay. So presently we have ICI has issued 27 AS, and this is the list of, whether what and all AS will be applicable to what level of entities, and whether it will be applicable for SMCs also. So all that will can come in one mark, but not that much necessary. So yeah, limitations of accounting standards. You see, complex financial instruments have come up like CCDs and so many shares and debentures, right? On which we were missing so many, measurement or recognition or any other principles as such in accounting standards. And also derivative instruments have come up. Okay. And group restructuring was there, as I told you. Business acquisition are there, mergers, demergers, slump sale, everything happens, right? And arrangements are complex nowadays. Business models are becoming complex, and even stock-based compensation. If we see, they are coming up with new thing, right? And it's getting diverse nowadays. So which necessitated the change in the accounting standard. So tax provisions in every each and every way, right? There was a new things that we needed to adopt to. So that's why we have included. There was a change. There was a need for a change. That's why the standards were revised and were issued as IFRS. So all these are theories. International Accounting Standards Committee is a committee, and FASB will also be a committee. So one thing, two prominent and widely adopted accounting standards have emerged. Okay, this is what on a global scale level, these two standards are what we are using. Okay, accounting standards set by US FASB, which we call it as Financial Accounting Standards Board, widely known as US GAAP. So this is US GAAP, what we use in US and few other selected countries, right? And IFRS is the one that got implemented for the change that was required. So these two have become a globally recognized standards that we are still using. Okay, so the same need. So cross-border transactions, and this was the reason why I told India had to converge to IFRS, right? So there are many cross-border transactions and free flow. In order to make the free flow of international capital easy, we had to converge or adopt to the IFRS and make it a universal or a simple, what do you say, a common accounting standard rule, so that we are not lagged behind and we are in par with other countries and the economies. Okay, and benefits of a global accounting standard: economic efficiency, and it strengthens accountability. So there is no information gap. And these all are one mark, if it can come, but I say never asks all these questions. So next is convergence versus adoption of IFRS. Yeah, so we need to understand the difference between convergence and versus adoption. So adoption is something like, FSB or IAC or any other accounting committee rolls out the standard, and then we, blindly adopt it. So whatever they have rolled out, we blindly take it as a guidebook and we blindly follow it. So in that case, we call it as adoption. And when we say convergence, right? So see, there may be country specific uh, scenarios that might differ, right? If you see HUF in India and how certain things work, right? Certain nature of entities work in India, for them it might not be, you know, it might not it might not be applicable. Whatever customs they follow, right? It might not be applicable, or it might be a new point in IFRS. So what we do is we take the IFRS, we see our customs and practices that our companies or entities are engaging in. We take it from that, we adopt it. We don't adopt it, like we take it, we add as an appendix, or we add that adjustment, or we bring in that adjustment into IFRS, and we roll out the standard for the on the national level for the entities or the organizations to follow. So that is what we say as convergence. So this is the basic difference. And so it might come in MCQ. Canada, Bahrain, Cambodia have adopted IFRS, while countries like India, China, and Hong Kong have converged with IFRS. This is one important point. Next, process of development and finalization of IndAS. So this is all nothing but the summarization of how IndAS has come into picture. So ISB issues new IFRS or updates the existing one. Okay, and what we do is we also deliberate and we try to bring the IndAS in line with IFRS. And then what happened? Draft IndAS goes to the council members of ICI for comments, and what their views are, we listen to it and we incorporate those comments. And exposure draft, we send it out to public comments, right, with exposure draft, and we receive the comments, we consider it, then we make changes if anything is necessary. Final draft submission is sent to NFRA with recommendations, and NFRA, which is nothing but MCA, notifies Indians under the Companies Act. So, under which section of Companies Act does all these accounting standards, are required to be followed? Or which section of the Companies Act says that you have to follow the accounting standard? This might come in MCQ. The answer is section 133. Yeah, this is all transition from AS to IndAS. So G20 summit, everything, blah, blah, blah. Let's ignore. And one simple point, IndAS 115 was applicable from 1st April 2018, and IndAS 116 was applicable from 1st April 2019. So these 2 points, big standards, just a point to note. Then comes the list of standards. We have 39 IndAS with us. I think insurance contracts, which got implemented last year, right? That was the new standard that came in. So please, I'll recite this. You also please listen to this so that you can recall it. So in days 101, first time adoption of Indian accounting standard. In days 102 was share-based payment. 103 is business combination. 105, 104 previously used to be insurance contracts, but they have changed the number and they have issued it under IndAS 117 now. So IndAS 104 is nothing. Okay. IndAS 105, non-current assets held for sale in discontinued operations. IndAS 106, exploration for and evaluation of mineral resources. IndAS 107, financial instruments disclosures. And in IndAS 108 is operating segments. 109 financial instruments, 110 consolidation, 111 joint arrangements, 112 is disclosure of interest in other entities, 113 is fair value measurement, 114 is regulatory deferral accounts, 115 revenue from contracts with customers, 116 is leases, and 117, which got implemented last year, is insurance contracts. So these all Indias that we see in hundreds, right, three digits, are all new standards that we have converged into. Okay. Previously, there was IAS, which we used to follow. Whatever changes they were able to do, basically the IASC or FASB as the case may be, right? So whatever changes they were able to do to the old standards, minor adjustments, and they released it as a new IFRS. So all those IFRS are in, single digit or double digit. All the new standards that have been completely revamped and issued are all in three digits. Just a point to note, right? So now coming to IndAS 1, presentation of financial statements, 2 is inventory, 7 is statement of cash flows, 8 accounting policies, changes in accounting estimates and errors, 10 events after the reporting period, IndAS 12 is income taxes, IndAS 116 is property, plant and equipment, IndAS 19 is employee benefits, IndAS 20 is accounting for government grants and disclosure of government assistance. IndAS 21 is the effects of changes in foreign exchange rates. 23 is borrowing cost. 24 is related party disclosures. 27 is separate financial statements. 28 is investments in associates and joint ventures. 29 is financial reporting in hyperinflationary economies. 32 is financial instruments presentation. 33 is APS. 34 interim financial reporting. 36 impairment of assets. 37 provisions, contingent liabilities and contingent assets. 38 is intangible assets. 40 is investment property and 41 is agriculture. Just a short trick to remember the financial instruments section correctly. 32P is presentation. Okay. Remember 32P is the code word. And, in the same way, financial instruments is 109. Remember that it's the plain standard. And 107D is for disclosures. So 107D or 7D, 32P, you just remember. Some people, confuse it. So they write 32 as disclosures and, 107 as presentation. So just to be careful. So yeah, this is what I told. How Indias have been numbered. IAS series are all old standards, are all in single digit and double digit. Whereas whatever new has come up, right, based on IFRIC. So IFRS Interpretations Committee, uh, they have all given, new standards. How Indias have been structured the same way as AS, right? First, it will tell you what the objective is. So they have given an example. India's two's objective is so and so, and what is the scope? What is the definition of the terms that are used in the standard? What is the content of the standard? What disclosure you need to give? What are the transitional provisions and effective date, right? So from what date you need to follow and what is the criteria to adopt it or how to transition to this. And then appendices or, which are integral part of the standard. So it's a detailed guidance on specific matters. Okay. Now comes the main part, roadmap for applicability of IndAS. So the basic thing in IndAS that you need to know is the roadmap. If you make any mistake in roadmap, then tata bye bye. You won't get anything, right? So as said, 39 IndAS, let's it's there are two phases, okay, of this roadmap. So let's take this roadmap, right? Phase one. So IndAS is applicable from financial year 16-17, okay, or we can say it as the opening balance sheet, right? Transition date, which we call it as transition date, as 1st April 2015, and the comparative period will be the last year ending date, which is 31st March. So always opening of the comparable period, right, will be called as transition date. If I say index is applicable from 16-17, you take the previous year, which is 15-16. What is the opening period? What is the opening period? Which is nothing but 1st April 2015. So we call this date as a transition date. So let's see what and all companies are covered under phase one. As I said, there are two rules, okay, under companies rules, 2000 companies rules. One is for IndAS, which is companies Indian Accounting Standards Rules 2015, and the another one is companies Accounting Standards Rules, which is 2006. Okay, 9 years of gap there is. So yeah, this is IndAS, and that is the 2006 wala is normal AS. Yeah. So phase one, as per the companies, following companies were covered under phase one. Please note the date. Everything here it says is 16. Okay, just for the shortcut. And in phase two, it will say 17. And the next thing that we will be dealing with is NBFC. It will say 18 and 19. So it's arranged in that way, we can easily remember. So for accounting periods beginning on or after 1st April 16, with the comparatives of the last year, right, which is 31st March. What and all companies are covered? Companies whose equity or debt securities are listed or are in the process of being listed. Okay, please note, listed or are in the process of being listed on any stock exchange, on any, I'm again repeating, on any stock exchange in India or outside India. Okay, underscore, underline outside India, and having net worth of rupees 500 crore or more. So what you will say, if a company has a net worth of 500 crore and it is trying to get listed, will this be applicable? And because it says 500 crore or more, right? So 500 crore is also included, and it is a and condition. It says both the criteria needs to be fulfilled to be, eligible under phase one. So the next thing is other companies to subclass A having net worth of rupees 500 crore or more. Or more. So basically, all the companies, right, be it listed or are not listed, if the company has a net worth of 500 crores or more, it will be covered under the phase one or roadmap for IndAS. And an important point about holding subsidiary, joint venture, or associate companies. All the companies related to the company that we are looking for the applicability in the roadmap. They have mentioned what it can be holding. The parentage will be included. Subsidiary, your subsidiary will be included. Joint venture, if you have any joint venture with any other entities, that also will be included. Or associate, if you have anything, that also will be included. So this is the phase one. Okay. So the criteria basically is 500 crores or more, listed or not listed, and all the HSJA. Okay. Holding subsidiary, joint venture, or associate companies. What is the date? 16, 17. Remember, here you have to write 16 everything. So what is phase two? The next year, 17, right? Accounting periods beginning on or after 1st April 17 with comparatives of 31st March 2017. Here, if you see, they would have so that was launched as a preliminary phase. So now they want to cover more companies inside the bucket, right? So what they did next was they reduced the net worth threshold to 250 crores. So, and for listed companies or in the process of being listed, they made it mandatory for them to adopt the index. So, if you say if you are giving an exemption to listed entities and if you are making other companies mandatory, right? So usually listed companies are big companies in India, right? Well recognized. If you say if you give them a gap that there is an exemption for you to not apply to India's, then it will not look good, right? So they have made under phase two all the listed companies or are in the process of being listed in India or outside India to mandatorily adopt the IndAS. Okay. And the next thing, other companies, they have given the exemption or they have reduced the threshold to 250 crore. So 250 crore or more, but less than rupees 500 crore. Okay, this is the condition. All the companies previously, that was the condition was like 500 crore and above, right? So now it is 250 crore and above. And the third point is the same, holding subsidiary joint venture or associate companies of the same companies. And when I say listed, right, listed or in the process of being listed, so whatever, like the companies are being listed on SME exchange, right? Small, medium, that kind of equity market exchange, then it, they are not said to be listed under this criteria. It is not mandatory for them to adopt the index. The same applies for institutional trading platform also. Okay. Phase two, this is the chart. So phase one was 16, 17, as you can see, and phase two is 17, 18. Okay. Just remember, it comes in an order way. Okay. 16, 17 is first, 17, 18 is second. Key matters, comparative financial information. So as I said, IndAS will be applicable from the beginning of the previous period, which we call it as a transition period. IndAS applicability at the end of, so that is nothing, a point, nothing. Consistent application of IndAS. Once you start to apply IndAS, you have to consistently apply the IndAS in the subsequent years also. Okay. For Indian group companies also, it is applicable. So as I told, right, holding, subsidiary, associate, or joint venture, it is applicable to all. And then overseas group companies, see, if there is a company, right, if there is an overseas subsidiary, associate, or joint venture, so they are required to give you the consolidated, for the purpose of consolidation, they are required to give you the financials, right? In what way they will give you, if you are preparing the financials under IndAS, they also need to give you under IndAS only, right? So in such cases, what the guidance says is, so you prepare, you are in foreign, right? So none of the laws of India will apply to you because you're a foreign registered company, not registered in India. So what will happen is you follow the jurisdiction rules of your place of, management. You take that standard, you follow that standard and prepare your financial statements. But also, right, for the purpose of consolidation, what you need to do is you need to you need to make a prepare the financial statements as per India's also, and then you need to send it to the your parent or your any other entity for the purpose of consolidation or any other requirement. So what the guidance says is please adopt either voluntarily or mandatorily the IndAS if that makes more sense, right? So this is the guidance that has been given, and standard it applies to IndAS applicability. So it both applies to standalone and consolidated. You cannot say that standalone is only applicable, consolidated IndAS should not be applicable. Now, both standalone and consolidated financial statements it should be applicable. So now comes the net worth, most important point, right? So wherever we see, right, phase one or phase two, what we say is net worth of 500 crores or more or 250 crores, right? So what is net worth? Under India, how do you calculate the net worth? So this is the thing. The net worth means the aggregate value of the paid up share capital and reserves and surplus. If I take one Excel, right? Let me take one Excel. Let me show it to you guys, right? So this will be for net worth. You take up paid up share capital. Okay, things to add. Paid up share capital will be added. Securities premium account will be added. All reserves out of profits will be added. Okay. What not to take? Accumulated losses you should not take. Miscellaneous expenditure not allowed. You should not take. And what is this other third thing? I forgot. Let's see. Deferred expenditure. You should not include these three, and you should include these three. Okay. It's not mandatory less. If it is provided in the balance sheet, ignore these three. Okay. So net worth, this would be the thing. And provided this reserves, right, should not be out of revaluation of assets or write back or depreciation or amortization. Okay, these are the only points that you need to follow. If you follow this, you will find out the net worth criteria. So let's read it out. Net worth means the aggregate value of the paid up share capital and all reserves created out of the profits and securities premium account. Okay, so general reserve is included, right? As it is only a part or reserve created out of profit. After deducting the aggregate value of the accumulated losses, deferred expenditure, and miscellaneous expenditure not written off, as per the audited balance sheet. but does not include reserves created out of revaluation of assets, right back of depreciation and amalgamation. Okay, so this is the thing that we have. And now, at what date you should calculate the net worth?